how do stocks influence gold prices? Or what is the relationship between gold and stocks? Well, the relationship between stock valuations and the gold price is widely debated. The standard view is that these two markets are negatively linked. That is to say, when stocks go up, gold prices go down, and vice versa. When stocks go down, gold prices go up. Now, this is indeed often the case, as gold is a safe haven, and so when events such as economic contraction and the investor anxiety that follows that up, or increase in interest rates, or outdated firms being replaced by new ones due to technological advancement. So when these events when they happen, that causes the value of paper investments such as stocks to decline. And this naturally puts traders into defensive mode. And as a result of that, they may prefer gold to other relatively risky assets. Now, I've got a chart here of basically the performance of various stocks in the US and the performance of gold in dollars. So as we can see here, the first thing that the chart tells us is that there is indeed a negative relationship. As we can see, all stocks which the light blue line is Nasdaq, the blue line is Dow Jones, and the purple line is S&P 500. We can see that they're all going towards the same direction. They're all going up, and simultaneously gold is going down, and when stocks dip, gold increases. There's spiking up. Now, so that's the first thing. The second thing is we can see the influence of the aforementioned events that I just talked about. So you can see that in 2011, obviously in 2011 there was the Eurozone sovereign debt crisis, and that obviously caused the price of gold to go really high. In the meantime, though, all stocks in the US declined. They all decreased, and we can see this playing out here. Now, when that economic contraction happened because of that crisis, we can see that gold actually outperformed all of these stocks. But after 2013, things started to change. We can see that all stocks, especially the Nasdaq, which is the light blue line, just really outperformed gold, and gold has been outperformed ever since. So this is telling us something. This could tell us that the stock market is booming. It could tell us that it's overvalued, and it's indirectly telling us that gold is undervalued despite these high prices. It's still undervalued, and probably it needs a readjustment of its price. It needs to start outperforming stocks as a bust eventually occurs in the future. Now, you could say that this chart in particular is very US centric, but the thing is, even if I put the chart for containing European markets or Asian markets, it would be the same thing. Basically, in 2008, there is a global financial crisis, all stocks dip, gold price goes up. you'll see that relationship play out every single time in every single chart in every single market. And also for 2011, no matter which market you're looking at, 2011 was the Eurozone sovereign debt crisis, and so even if I look at the European, Asian, or whatever market, the relationship is actually the same. And so there is no point in doing so. And also I don't want to make the video too long. But what I wanted to show instead was whether or not there are exceptions to this rule. And I did find one exception, and that is the Mexican market. So as we can see here, there is actually a very mildly or acute positive relationship between gold and the Mexican stock market. We can see that it kind of follows each other. They kind of follow each other, and we can see that they're going towards the same direction most of the time. Because this is very interesting here. So this dark blue line represents the Mexican stock market, and then the red one is the gold performance of gold. So we can see that as the Mexican stock market rallies, as it's going up, we can see gold prices also moving up. Now that is very strange. So what is the reason behind this? Why doesn't the rule hold in this market? Well, I did some digging, and I found that the mining sector in Mexico accounts for more than 8% of the country's GDP, according to Deloitte, which is a very credible firm. So that's very interesting. Now I know this is a lumping in of all these different mining companies. So this is the aggregate mining companies. So that includes copper miners, iron, or whatever else. But even let's say half of them are just pure gold miners, that will be 4%. I mean, that's still pretty high. So, but nonetheless, the thing about Mexico, as we know, is it's a very wealthy, naturally well-endowed country. It produces a lot of silver, a lot of gold, and so gold is quite important for their economy or economic growth. They export a lot of gold as well, so gold is really important for their economy. And so a natural linking of these two things is obviously going to create this positive relationship. However, if we follow this rationale, then would a country like South Africa, which also produces a lot of gold, exports a lot of gold, wouldn't we see the same thing? And wouldn't we see the same thing if you look at the markets of all major gold exporting countries and see whether or not they have a relationship with positive relationship with gold? What is the answer to that? Well, let's look at the South African market. So in the South African market, which is again this dark blue line representing the South African Stock Exchange, basically a composite of everything, and this red line is the gold price, gold performance, and we can see a very clear relationship, very clear negative relationship. As the South African stock market is falling, we can see gold price increasing. or gold performance increasing. So why is it not positive like the Mexican one? So the answer to that is, I think, boils down to what percent the mining sector accounts for in each country's GDP. So in South Africa's case, mining actually accounts for 4.6% of the country's GDP. So that means that although South Africa produces and exports a lot of gold, I mean, even the gold Krugerrand coin is so popular, is so widespread. I mean, it's a country that is also very well endowed in gold deposits. But however, compared to Mexico, the mining sector is only 4.6%. It only accounts for 4.6% of country's GDP. But for Mexico, it was more than 8%. So as a result of that, we could conclude by saying Mexico's economy relies on gold more than South Africa's economy. So therefore, the relationship between gold and Mexican markets are going to be stronger, simply because there is more activity, there is more output, industrial output of gold. There's an interlinkage between the stock market, gold, the economy, plus the currency. Just like the Australian example that I talked about in my previous video. So yeah, to conclude, in general, the relationship between stocks and gold, it is indeed negative most of the time. However, there are exceptions like the Mexican market. But other than that, basically any other country that is a large producer of gold, a country that has a lot of mining companies that that account for large percentage of the GDP, in those countries you may see a positive relationship between gold and stock markets.